Dear listeners, you are most welcome to episode 2 of CPA 11 mock debrief, where we are looking at the mock of May 2026 examination diet. My name is CPA Norbert Triamachi, and I will be your lead facilitator for this mock debrief. Yesterday, we looked at question 1 and question 2. So today, we're going to continue with the remaining questions. That is question 3 up to question 5. Like I told you, this examination has section A and section B. So today, we are going to straight away go to question 3. Question 3 was examining VAT, value added tax, looking at it is looking at value added tax. So it reads: Next Season Uganda Limited is a manufacturing company involved in the production of plastic items for both domestic and commercial use. The company's main markets are in Burundi and Rwanda. Sales are carried out both directly through Nur's outlets and through commission agents operating in the border districts of Kabale and Chisoro. So when they give you this question, they first give you the introduction. The most important thing to note is that is where the industry, where the business, the industry of the business, and you know that it is in manufacturing, and its major markets are in Burundi and Rwanda, meaning that you expect to have exports. For the month of February 2026, Nur recorded the following transactions. Nur sold medical gumboots to Doman Hospital in Kawempe, in Kampala, valued at 9.3 million. Water tanks worth shillings 12 million were sold to a commission agent in Kavira town, Burundi. Plastic plates and cups were supplied to on credit to Tusome Primary School in Bulindo, Kampala at a value of 4.3 million. Nur received rental income of 105.4 million from leasing part of its warehouse in Kabale City for the month of February 2026, March 2026, April 2026, and May 2026. During the same month, Nur engaged Yokeres Viga, a software engineer based in England, to remotely customize and install a new QuickBooks accounting system. He was paid 4,200. Now, with this question of VAT, majorly what you need to note is that it is governed by the VAT Act. It's governed by the VAT Act, Cap 344. And the VAT Act specifies how to treat transactions for VAT purposes. The next thing you need to note is that once they give you transactions, they're interested in you identifying the different supplies. So we have different types of supplies, where we have taxable supplies, and exempt supplies. Taxable supplies are further classified into zero rated supplies and standard rated supplies. Standard rated supplies. Rated supplies are taxed at 0%. Standard supplies are taxed at 18%. And exempt supplies have no applicable rate of VAT. And what you need to further note is that the VAT Act Cap 344 specifies only two types of supplies. Specifies the zero rated supplies and exempt supplies. So this zero rated supplies are specified in schedule 3 of the VAT Act. These ones are specified in schedule 4 of the VAT Act. Now, once a supply is not mentioned in zero rated supplies or exempt supplies, it means it is a standard supply. It means it is a standard supply. And the examination is basically testing these areas. It is basically testing these areas. And it is basically testing these areas. Now, once this question is asked, they'll be testing how to compute the tax payable. So the VAT payable or claimable is equal to output VAT minus input VAT. The other thing you need to note is that output VAT is VAT on sales, and input VAT is VAT on purchases or expenses. That's what you need to understand. So the examiner is basically interested in knowing this. If output VAT is more than input VAT, it means you have what you call VAT payable. If input VAT is more than output, you have what you call VAT claimable. The other thing he tests is not all expenses and purchases VAT can be claimable. So you may find that there is that VAT which is not claimable. You have incurred it, it will be incurred, it will be paid, it is standard rated, but it is not claimable. As we shall be seeing that, I will show you how to pick it up from the question. Now, with this background, let's now dive into the question. But before there, what you also need to note is that when the examiner says this question, he normally specifies whether expenses are VAT inclusive or exclusive. All exclusive. So other times he can tell you that if the transaction is VAT inclusive, it means that you get 18 out of 118. That's how you get the VAT amount. So you get the VAT amount. If the transaction is VAT exclusive, if it is VAT exclusive, to get the VAT amount, you use 18% or 18 out of 100% to get the VAT amount. Again, these formulas are clearly stated in the VAT Act, Chapter 344. So let's now move to the question. The examiner, under required, is asked to advise null on the VAT payable or claimable for the month of February 2026. So we shall have our heading null VAT payable all claimable or claimable for the month of February 2026. And you can have your amounts in shillings of 1,000. In shillings of 1,000. Now, when you are organizing this, you need to start with output VAT. So you start with output VAT, and then input VAT comes last. So the output VAT is VAT on sales, and then you need to specify whether this is VAT inclusive or exclusive. That's normally given in the last note. So you can check note 9, say that all sales figures are inclusive of VAT, while purchases are exclusive of VAT, meaning that output, which is on sales, is VAT inclusive. So it means that this is inclusive. You can write it here. It is inclusive. And we say that inclusive is 18 out of 118. Meaning that to get the VAT, we shall multiply by 18 out of 118 to get the amount of VAT that is payable. So you have a small table which will have details here. You will have the computation. You'll have the VAT amount and the comment. So most times or sometimes the examiner does not tell you which transaction is on output VAT, but other times he can specify. He can give you sales and purchases, separating them. But other times he may not necessarily give you those details. So it is you, the student, to know that these transactions are sales. This transaction is a sale. This transaction is either a purchase or an expense. So note number 1, they are telling you that Null sold medical gumboots. So the first one is medical gumboots. And you know that medical gumboots are exempt supplies. They're exempt supplies per Schedule 4. But you have to put the amount here. So this is 12 million. Is it 12 million? No, it is this 9.3 million. So it is the rate has no rate applicable. Then you come here and say it is exempt. Now when they are giving marks, they will award the marks on the VAT amount and the marks on the comment. So that you have finished. Go to the next one. Water tanks worth 12 million were sold to commission agent in Kabira town, Burundi. So we have water tanks. Water tanks. So the water tanks are 12,000. So what you need to know is that this is an export. And the VAT Act classifies exports as zero rated supplies. So this one will be charged VAT at zero rate, which will be 0 here. And you come here and say it is 0 rated. It is 0 rated. You move to the next, which is plastic plates and cups were sold on credit to Some Primary School in Burundi at a value of 4.6. So they sold plastic cups. Now, with VAT, time of supply is the area of the delivery date, delivery date, performance date, or payment date. It does not matter whether you have received the payment or not, because the default method of accounting for VAT is accrual method of accounting. So even when you have not received the payment, so long as you have made a supply, then we say that you account for VAT in the month when the supply has taken place, not when you have actually received the supply, not when I have actually received the payment, meaning that this credit supply, we shall charge VAT and pay it to government as at the date of supply, not when we will receive the payment, because it was sold on credit. So I am having 4,300 times 18%. So this one will give you 774. So this one is standard rated, because plastic cups are not mentioned either in the exempt supply or zero rated supplies. So meaning that they are standard rated. No received rental income. So rental income. Again, under the time of supply, we do not consider the period of the payments. Even if you have received the payment, but the payment is for 12 months, you account for VAT when you have received the payment, because the area of the payment date, delivery or performance of a service, or the payment date. So here, we're going to consider the area of the payment date. For all these months is 105,400 times 18%. So we do not only account for the VAT for the month of February, we shall only also account for the one of March, April, May in the month of February, even when we have not yet we received it, even when even when we have not earned it, because in accounting we would only recognize income for the period that has already passed. But here, we account for VAT on the whole amount. 18,972. This is standard rated. Standard rated. Move to the next. During the same month, Noel engaged Yokres Viga, a software engineer based in London. Now, this is import of a service. Import of a service is accounted for separately. So you first skip this. Import of a service is accounted for separately. So this we shall put a star. We will look at it later. And then during the month, no incurred the following expenses. So you can see these other ones are expenses. So meaning we could as well get the total for this, which is total input, but we can do it later after we have looked at input VAT. So after that, you also look at input VAT. So you have to make sure that these ones are not mixed up. So input VAT, like they have showed us, they have given us, and note 9, it is exclusive. And we said exclusive is 18%. Oh, this one we were supposed to use 18 out of 118. So I'm going to change this. This should have been 18 out of 118. This should have been 18 out of 118. 18 out of 118. Because we had said here that output VAT inclusive 18 out of 118. Meaning that these answers will have to change here. This will have to change. So we shall get 4,300 times 18 out of 118. So this will give us 656. And we shall have 105, 400 times 18 out of 118. This one will give us 16078. Will give us those amounts. Then we move down to input VAT. So input VAT, the first one are saying incurred the cleaning expenses. So of course we shall have our details here. Shall have our working, what we call computation. Shall have the VAT credit, and then this will be the comment. Now when you are commenting here, you use words like creditable or claimable. So we shall have cleaning expenses. So cleaning expenses, it is 6.2, so it is 6.2 times 18%. 16.2 times 18%. I'm going to use lines here, which will give me, it was paid to Jingo. So we shall have 6.2 times 18%, which will be 1116. So the VAT credit is 1116, and this is claimable. So you use the words claimable or creditable. And then the next is along with the following administrative expenses. We have telephone. Now what you need to note is that telephone is divided into two. We have 90% telephone costs and 10% telephone costs. So the 90% will be 90% times the amount, which is 10,500 times 18%, which will give me, you put on your calculator 90% times 10500 times 18% times 18%. This one will give me 1701. Should be 1701. This one is claimable. Now the 10%, which is 10% times 10,500 times 18%, is not claimable. This one you're gonna pay it, but you cannot claim it. So it is 0.1 times 10,500 times 18%, which is 189. So since it is not claimable, we are not going to put it here. We shall put a dash and we say not claimable. We say not claimable. This is not claimable in accordance with section 28, subsection 6 of the VAT Act. Next, we look at electricity. We have electricity expenses. So electricity expenses, it is 6.2 times 18%, which will give you 16.2 times 18%, which will be 1116. So it is 1116. It is claimable. This one is claimable. Then we have water expenses. Water expenses is 1900 times 18%, which gives you this 1900 times 18%, which will give you 342, and this one is also claimable. Is also claimable. Then we have warehouse rent. The warehouse rent in each solo, which is 2.3, which is 2.3 times 18%. 2.3 times 18%. This will give you 414. So it is 414, which is claimable. Next, we have salaries and wages. Salaries and wages. So salaries and wages is 63,800. Now with salaries and wages, they are out of scope. Out of scope. So we do not compute their VAT, but they are actually out of scope. We do not pay VAT on salaries. Next is purchased a Toyota Land Cruiser. Toyota Land Cruiser. So a Toyota Land Cruiser, a Toyota V8 Land Cruiser, the cost was 520 million times 18%, which will be how much? It will be 520 times 18%, which will be 93,600. Now, section 24, subsection 9, and subsection 10 of the VAT Act explains what we call a passenger automobile. It explains a passenger automobile. And section 28, subsection 6, limits the claiming of the input VAT on a passenger automobile, meaning that the VAT is standard rated, we are going to pay it, but we cannot claim it unless the business is in the trade of the automobiles. If it is, let's say, a bond, it is buying and selling cars, it is in the business of buying and selling cars, or it is in a business of hiring cars, then its VAT can be claimable. But a business in other entities that is not dealing in VAT, its VAT cannot be claimable. So we're going to say here, we're going to say not claimable. That's for passenger automobile. Now, the same section, section 24, subsection 9 says it is passenger automobile and repairs and maintenance of such automobile. So even the repairs and the maintenance of that automobile is not claimable. So it is 4,500 times 18%. The VAT on the repairs of the Land Cruiser will also not be claimable. Times 18%, which is 810. So it is also not claimable. Not claimable. Next, during the month, one of Noor's truck heading to Rwanda got an accident and items worth 5.4 were destroyed. And Noor had paid input VAT. So this is regarded as a sale, because when a sale is when you take away the items. It is regarded as a sale, but the VAT will not be claimable. So the VAT will be recovered. So we're gonna say goods destroyed. So we shall put them under output VAT. Goods destroyed of how much? Of 5.4 times 18 out of 118. So we shall have 5,400 times 18 times 18 out of 118. So the VAT of 824 will be standard rated. So you put it in brackets because it is for goods that are destroyed. It's going to reduce on the output VAT that you will be paying. All sales were all sales were inclusive. So then you balance off. So you balance off by getting the total input VAT and the total output VAT. Total output VAT. So the total output VAT will have 656 plus 16,078 minus 824, which will be 15,910. 15,910. You know, move down. Get the total for this, the one which is claimable. So it will be 116 plus 1701 plus 1116 plus 342 plus 414, which will be 4689. So to get the VAT payable or claimable, we shall get output VAT minus input VAT. Output VAT minus input VAT. So the output VAT minus input. Input is 4689 and the output is 15,910. Is 15,910. So you'll have what we call VAT payable. So the VAT payable for the month will be 4689 minus 15,910. 15,910, which will give you 11,221. This one will be the tax. So therefore, VAT payable for null for the month of February 26 is shillings 11,221 millions. That's the advice you are giving to null. Part B of the question is asking, in accordance with section 28 subsection 6 of the VAT Act, Cap 344, a taxable person shall not qualify for input tax credit in respect of a taxable supply or import. Explain the limitation on claim for input VAT. So the ones which are not claimable is what we have been talking about. One, we said we have a passenger automobile. Purchase or import of a passenger automobile, unless where the person is in the business of trading passenger automobile or is in tours and travel. Then in such a case, the passenger automobile would not be claimable. Then 2, repairs and maintenance of such automobile. Repairs and maintenance of such automobile would also not be claimable. Then 10% telephone costs. 10% telephone costs are also not claimable. Then also expenses not related to the business. Not related to the business. If you incur expenses that are not related to the business, e.g., private expenses, they would not be claimable. And we also have entertainment expenses. Entertainment expenses. They are VAT standard related but not claimable. Unless the person is in the business of entertainment, is providing entertainment services to our customers. In that case, it would be claimable. But generally, entertainment expenses, e.g., staff parties, a purchase of alcohol, and other related entertainment expenses are not allowed for claiming. So those are some of the limitations. So that is question 3, which was taking 20 marks. So now, let's look at question 4. Let's look at question 4. Question 4, what did it talk about? Question 4, they examined adverse tax on part A. Part B, they examined rental income. And part C, withholding tax. So let's look at 4A first. 4A first. So I think in February 2026, ABACUS purchased 8 84-seater buses, 6 28-seater customized luxury buses, 7 9-ton trucks, and 3 25-ton trucks for the purpose of operating a transport business in Uganda. Lucas has been informed that he needs to obtain a clearance certificate from commissioner in advance of deploying his vehicles on the road, where determining the adverse tax that Lucas will be charged for the vehicles before obtaining a transport license for Max. Now, what you need to note is that vehicles in Uganda, passenger vehicles and cargo vehicles, they pay tax called adverse tax. But these other vehicles of me and you, where it is used for personal use, not for passengers or for cargo, no adverse tax is required. Even borders, they pay. So for passenger vehicles, they pay 20,000 per passenger per year. 20,000. For cargo vehicles, they pay 50,000 per ton. So this one is paid in tons. Per ton per year. It is as simple as this. So let's look at the first one. The first one they have buses. So we can have details here. Then computation. And then adverse tax. Adverse tax. So the buses, they're saying they are 8. So it is 8 times 84. So there are 8 buses and there are 84 seats. So we shall get 8 buses times 84 seats. Times buses, they take passengers, not cargo. So times 20,000. So what will be the tax? So we shall have 8 times 84 buses times 20,000, which will be 13.44 million. Those are the 8 buses. 8 buses. Then we have, these are 84 seater. Then we have 28 seater luxury buses. So these 24 8-seater, so we shall get 6. There are 6 times 28 buses times 20,000. We shall have 6 times 28 times 20,000, which will be 3,360. Next, we have trucks. We have trucks. So we have 9-ton trucks. So which one we have? 9. Actually, there are 7. So it is 7 times 9 trucks times 50,000. Because each ton is paid tax at 50,000. So we shall get 7 times 9 times 50,000, which will give you 3,150,000. Then we have 25-ton trucks. So these ones, it will be, there are 3 times 25 tons per truck times the 50,000. So it will be 3 times 25 times 50,000, which will be 3,750,000. Then after you add the tax, total adverse tax that ABACUS will have to pay. So which is 13,440,000 plus 3,360,000 plus 3,150,000 plus 3,750,000, which will give you 23,700,000. So will be the adverse tax, and this would earn you the 4 marks. Let's go to part B of the question, 4B. So 4B was examining rental tax. 4B was examining the rental tax. So it says, Lucas operates Lolax Property Masters Limited, Lolax, a real estate company with rental properties in Kampala and Wakiso. For the year ended 31st December 2025, Lolax earned rental income from both locations. In Wakiso, the company owned 200 units, each generating 1.2 million per month. However, by year end, rental income tax relating to 80 units remained outstanding. In Kampala, Lolax received shillings 320 million in rental income, of which 15% relates to the period January to June. Lolax also incurred the following expenses during the year. So the expenses are there listed. Determine the chargeable income and rental tax payable by LORAX for the year ended 31st December 2025. So with rental tax, what you need to note is that you get the gross rental income for the year and you less allowed deductions. The allowed deductions, as per the Income Tax Act, they are maxed or they are capped at 50% of the total gross rental income. So let's see how it rolls. So we shall first get the incomes, the gross income. So the gross incomes are in two areas. One, we have in Wakiso, shall determine the income in Wakiso, and then the one in Kampala. Saying in Wakiso, the rental income will be according to what? So in Wakiso, you owned 200 units, and each unit was generating 1.2 million per month. So we multiply by 12 months. So here we can have it in shillings of 1,000. So what would be the amount? So it will be 200 times 1.2 times 12 months, which will be 2880 billions. These are months. So that's the rent for the month. But then they have told you, however, by year-end rental rating to 80 units remained outstanding. It means that of this rent of 2.8, the 80 units had not yet paid. But with rental tax, with the income recognition of income, we do not mind whether the income has been paid or not, so long as it has been earned. Meaning that I do not have to mind about what is still outstanding, so long as it has been earned. So let's look at the rental income in Kampala. So the one of Kampala, we have rental income. So the rental income in Kampala is 320 million. For it, they have given us 320 million. But of the 320 million, I'm telling you that of which 15% relates to a period January to June 2026. Meaning that we have what we call the prepaid, which is January to June 26. Now, for this period, we shall remove it, which is 15% of the income that has been earned, which is 15% times 320,000. So we shall get the 1.5 times 320,000, which will give you 448,000. It means that this income is for the period of January, much as it has been received, but it is for a period, for a future period. Therefore, we cannot tax it now. So what relates to this period is 320 minus 48,000, which will give you 272,000. Meaning that this is the rental income that was for Kampala. So total gross rental income would be 272 plus 2,880,000, which is 3,152,000. This will be the total gross rental income. So after getting the total gross rental income, then we less allowable deductions. So like I told you, this one you have to do a working, because you have to compare 50% of total gross rental income vis-a-vis the total expenses. So we shall have our workings. Let me just put my workings here. So workings, we have working 1, which is for allowable deductions. Allowable deductions. Allowable deductions. So allowable deductions, like I told you, it is that is part of the expenses that are allowable for tax purposes. And this one is follow section 22, subsection 1, the general rule that expenses are allowed for tax purposes to the extent that they are incurred in production of income, included in gross income for the year of income. That's when you can allow them as allowable deductions. Now, so the allowable deductions, 1, we have garbage. The expenses they have given you, garbage collection costs. This one is allowable 27,200 using the shillings of 1,000. We can actually have then comment. Okay. So have amounts here in shillings of 1,000. So this is 27,200. We shall say this is allowable. Is an allowable deduction. Then we have guarding costs, guarding and security costs of total of 100. This one is allowable. Then we have electricity. So the electricity, they happened at Lucas's personal residence, meaning that these ones are private expenditure. They are domestic in nature, but they happened at his home. So they are not allowable deductions. This one is not allowable. So we are not going to consider that expense. Then we have fines and penalties. Fines and penalties. TURA. These ones are also not allowable deductions as per the Income Tax Act. We have building maintenance costs. Building maintenance costs. These ones are allowable. 78,200. These ones are allowable deductions. Then you have interest on mortgage. Interest on mortgage of 181,000. This one is the allowable deduction. So you follow the same rule we use under business income to determine the allowable deductions. So what will be the total allowable deductions? The total allowable deductions, we have 27,200 plus total of 100 plus 78,200 plus 181,000, which is 298,500. So this one are the total expenses. So we bring them up here. But before we bring them, we have to first compare. What is 50%? We make a comparison versus, we get these expenses versus 50% of gross rental income. So the gross rental income is already given up as 3,152,000. 3,152,000. So we shall multiply by 50%. because expenses are given at a maximum of that rate. So we shall get 3,152,000 times 50%. This one will give me 1,576,000. So it means that given that my total expenses are below the threshold of 50%, we will allow expenses in its entirety. So we shall allow this as an allowable deduction of 298,500. Come here, we allow 298,500 as an allowable deduction. When we rest that, we shall get what we call the chargeable income. The chargeable income, it will be 3,152,000 minus 298,500, which will give me 2,853,500. Then I charge tax, rental tax at 30%. Because for companies, they are taxed at 30%, which would be 8,560,50. This would be my tax that I would pay to the Uganda Revenue Authority. And this was earning you 10 marks. It was earning you your 10 marks. Then part C of the question. Part C of the question was saying, in accordance with the Income Tax Act, Cap 338, explain the circumstances under which withholding tax is considered final tax and implications of withholding tax as final tax. Now, I want to first explain this. So, businesses, once you are in business, URA, through the Commissioner General, may designate certain entities to withhold tax on payments. And once this tax has been withheld, it's like the income tax they withhold from you, because at the end of the financial year, you are required to pay tax at 30%. But then as the suppliers are, as your vendors are paying you, they withhold 6% or a certain percentage, depending on the rates for certain payments. So you as a taxpayer, you have a right to use this withholding tax as a tax credit. But then there are certain payments, when they are withheld on, then such payments, you are not required to pay more tax on it. So they are asking the circumstances under which, when they have done the withholding, that now the withholding they have withheld is final tax, is considered as final tax. And then the implications when the withholding tax is considered as final tax. And that's what we shall be looking at. Now, the Income Tax Act specifies payments that are specifically the circumstances. So the following are the circumstances where withholding tax is considered as a final tax. One is where tax has been withheld on interest. Tax has been withheld on interest and from treasury bills. Interest and from treasury bills or other government securities paid by the Bank of Uganda. Paid by the Bank of Uganda to any person. So then, if you have earned this interest, the withholding tax they withhold on this payment is considered as final tax. 2 is where tax has been withheld on commissions and tax has been withheld on commissions and by a resident individual from airtime distribution or provision of mobile money services. So meaning that if someone has earned commission on the airtime or on provision of mobile money services, such withholding tax is considered as final tax. Meaning that if MTN pays the mobile money agents, if it pays them commission, they are not required to pay more tax on it. That tax they pay on that income is considered final tax. Then 3 is where tax has been withheld on dividend payments made to a resident individual. Where tax has been paid on dividend payment made to a resident individual. It means that here the tax is also considered final tax. So there are some of the circumstances for withholding tax as final tax. Now, they also ask the implications. So when the withholding tax has been withheld and we're saying it is final tax, what are the implications of this? 1 is that the taxpayer has no further tax obligations on the income from which tax was withheld. So he has no further tax obligation. He cannot pay any other tax on that income. 2, the income is not aggregated with other incomes. The income is not aggregated with other incomes for purposes of ascertaining the total chargeable income. So you cannot again add it to other incomes. Then 3, no refund of tax is allowed in respect of such income. So the tax cannot be refunded. You cannot use it as a tax credit. So there is no refund that can be made. So that are the 3 implications of withholding tax as a final tax. So the last question is question 5, which is about customs management. Question 5. Let's look at it. Question 5. So question 5 is asking compute the customs value and taxes payable by ADR for the importation. Aziz Distributors Limited is a soft drink bottling company producing mineral water and has recently expanded into packaging juice and other soft drinks. For its packaging juice, for its juice packaging line, they did imported a filing machine from Manchester in the studio city, London. The company paid US dollar 2,200 for the machine at the factory, US dollar to 720 to transport it to the port of export, US dollar 105 for insurance, and US dollar 390 for freight to the port of Mombasa. Additional payments to the manufacturer included 140 for a non-refundable container and US dollar 1,350 for training fees. As part of the purchase, the manufacturer also provided startup bottling supplies free of charge, valued at 1,700. Separately, the control unit of the machine was sold by the manufacturer at 3,400 and airlifted from Amsterdam International Airport, Netherlands, to Entebbe International Airport, Uganda. The associated costs included US dollar 130 for air freight and US dollar 60 for flight insurance. And then they give you the different types of taxes. Now, with customs management, what you need to understand is that it looks at the import of goods and services. So you are importing goods. As you are importing them, you need to pay tax. So now the question is, how much tax do you need to pay? And that's the major focus of the question. So you can be importing anything from outside Uganda. Once you reach the point of Mombasa or any point of entry into Uganda, you need to pay the tax. You as a tax accountant, you need to compute the customs value and the tax thereon. And that's the major thing. So we're going to walk through the question and see the solution of this. So we have details here. We shall have computation, shall have amount, and then comment. So one is they imported a filing machine. Filing machine. So the filing machine, they paid 2,200 times the cost. So the cost, I mean the rate was given at 3,850. So how much is the cost of this? So you can have amounts in shillings of 1,000. So as you are looking at this, not all amounts are included. So you may find that there are some amounts that are not included in CIF and other amounts are included in CIF. So we shall have 200 times 3,850. So this one will give us 7,770. And this is CIF included. Next, transport. So we paid transport to the port of export. The transport to the port of export, which is 720 times 3,850, which will give me how much? 720 times 3,850, which will give me 2,772. And we say this is CIF included. Next, we have transport to the port. We have insurance. So we have insurance of 1,050 times 3,850. 1,050 times 3,850, which is 4,042.5. This is CIF included. CIF included. Next we have freight. Now what you need to note is that freight does not mean air. Freight could mean any other form of transport. So here they said 390, 350. So we have 390 times 3850, which is 1501.5. This CIF included. CIF included. Next, we have additional payments to the manufacturer included 140 non-returnable container. A non-returnable container is included, but a returnable container is not included. Non-returnable container. So the non-returnable container was at $140 times 3,850. So it is 140 times 3,850, which is 539,000. The CIF included. Next, we have training fees. Training fees are also included. Training fees. Training fees of 1350 times 3,850. So it will have 1350 times 3,850, which is 5197.5. Which is CIF included. As part of the purchase, the manufacturer also provided. So when they start up bottling supplies free of charge. So even this one that were provided free of charge will be included. Bottling supplies. Bottling supplies of 1700 times 3,850. So get 1700 times 3,850, which will give me 6,545 CIF included. CIF included. Separately, the control unit of the machine was sold by the manufacturer at 3,400. This is the control unit. Control unit was sold at 3,400 times 3,850. So we get 3,400 times 3,850, which will be 13,090. CIF included. CIF included. After that, they are saying that and they are lifted from Amsterdam International Airport, Netherlands, to Entebbe Airport. So how much did it cost? The associated costs were 130 for air freight. So we have air freight. Air freight was how much? Air freight. So the air freight was the associated cost was 130. So it was 130 times 3,850. Is 130 times 3,850, which is 500. Now this one is CIF excluded. Air transport is CIF excluded. But air flight insurance on air is included. Flight insurance on air is included, which was $60 times 3,850. 60 times 3,850, which is 231,000. This is CIF included. CIF included. Then after, you add to get what you call the total customs value. Total CIF or customs value. So you add them by getting 700 plus 2772 plus 4042.5 plus 1501.5 plus 539,000 plus 5197.5 plus 6545 plus 13,090 plus 231,000. Actually, this is 231, not thousands. Plus 231, which will be 650 079.5. 650 079.5. Let's see, we have 77, 2.7, 4 million, 15. That. Okay, so we get that figure. So after we get that, then we have to compute the taxes. So the first tax is import duty. So import duty is 25% times 65,079.5, which will give you, this is now the tax payable, which will give you that times 0.25. It will give you 162,519. That would be the tax. The next tax is the VAT. So VAT, now actually for import duty, it is the rate. The formula is the rate times CIF figure. The one for VAT is import duty plus import duty plus CIF, then times the rate. So import duty, which is 162,519 plus CIF, which is 650 079.5 times 18%. Times 18%, which will be that plus 650 079.5, then times 18%, which will give me 146,267.9. Then after that, we do withholding tax. Withholding tax is the rate times CIF, which is 6%, the withholding tax provided, times 650 079.5, which will give me 650 079.5 times 0.06. which will be 39,004.8. Next, we have infrastructure levy. Which is 1.5%. Actually, the formula is the rate. It is the rate times CIF. So the environmental levy rate is 1.5% times CIF, which is 650,079.5, which will be equaling to 1.5%, 0.015 times 650,079.5, which will give me 9,751.2 as my infrastructure levy. Then that will be the infrastructure levy, and you total them to get the total tax payable, and you get your 14 marks. Part B of the question was asking, in accordance with the Income Tax Act Cap 338, explain the circumstance under which a taxpayer is treated as having disposed of an asset. So disposal of an asset is in different forms in accordance with section 48 of the Income Tax Act. Talks about capital gains tax. This is an area on capital gains tax, disposal of an asset. So disposal of an asset is in many forms, but one is called SAD, which is if the asset is sold, so you start by saying the asset is treated as having disposed of. The taxpayer is treated as having sold off the asset if it is sold, it is exchanged, it is redeemed, or distributed by the taxpayer. Then we say that the asset has been disposed of. Third, 2, if it is transferred by way of a gift, by way as a gift. Then 3, if it is disposed in part disposal, if it is converted, if the asset is converted from a taxable use to a non-taxable use, and the Commissioner General of Yara is satisfied. And then 3 or 4, where it is converted from non-taxable, this is now the vice versa of the above, from non-taxable use to a taxable use. We say that the asset has also been disposed of, and the Commissioner is satisfied. So that are some of the areas where the asset is treated as having disposed of. Then Roman 2 is asking, in accordance with the Income Tax Act, explain circumstances under which no gain or loss on disposal of an asset is taken into account when determining chargeable income. So here, the asset has been sold, but then we say that there is no gain or loss. So the circumstances include the following. 1 is transfer transfer of an asset between spouses. If the asset has been transferred between spouses, we say that there is no gain or loss for purposes of capital gains tax. If there is transfer of an asset between former spouses as part of divorce settlement, or bona fide separation agreement, then we say that there is no gain or disposal. If there is involuntary disposal of the asset, to the extent that the proceeds of the assets are reinvested in a similar asset within 1 year, then in that case also there is no disposal. There is no gain or loss. So those are the areas where the gain or loss is not recognized. So majorly you'll get 3 marks on each part. So so this is all about this exam, and like I told you, this paper is very easy to pass. You just need to concentrate on the key areas which I have mentioned. You need to concentrate on business income. You need to concentrate on employment income. You need to concentrate on partnership income, capital gains tax, withholding tax. You need to concentrate on customs management. You need to concentrate on rental tax and VAT. So these are the major topics that are examined in this paper. 1, 2, 3, 4, 5, 6, 7, 8. They are the major topics that are examined in this paper that you need to be aware of before you go to the exam. The exam will be set on May 20th for paper 11, and at MAT Abacus we will continue teaching for the December sitting, which will be communicated by management when the next classes will start. You are encouraged to come and enroll with MAT Abacus and continue with the classes. Thank you so much. I wish you all the best, and I wish you success in your forthcoming exams. I remain a CPA Norbert Tuyamhachi, a CPA tutor for paper 11 at MAT Abacus Business School. Bye.